Premier Brain was established 10 years back in Dubai and currently has their office in Abu Dhabi as well. Internationally, we are present in Oman and Kuwait. Our business is divided into four key line items. The first line of business is audit, which include external audit, internal audit, due diligence, liquidation assistant, and fraud investigation. Second line of business is tax and compliance, which includes tax agent, tax consultancy services comprised on VAT, excise, transfer pricing, ESR, and AML compliance. The third line of business is accounts, which covers outsource accounting and CFO services. The fourth core line of business is risk advisory, which covers business valuation, policy manuals, business plans, and feasibility studies. Our motto is to always doing the right thing, and our goal is to become an international brand name. So without taking too much of your valuable time, I will just mention that today will be two speakers. The first session will be conducted by Bhavna Chawla, who is a qualified chartered accountant from India with 19 years of experience in the field of taxation. She has been associated with Premier Brains for the past 9 years and previously has worked with Big Four firms and MNCs. Currently, she is tax partner with our firm and heading the tax department. Bhavna will take you through some key highlights of introduction about the corporate tax, tax rate, effective date of the tax, transfer pricing, threshold, tax liabilities, and free zones. Our second speaker would be Rishi Chawla, who is chartered accountant and MBA with certifications in AI, machine learning, and forensic. His previous experience includes working with Big Four and private equity firms, and last 10 years he's partnered with Premier Brains. Rishi will be taking you through from the details about exempt income, tax group, small businesses, deductions and tax losses, and a way forward. And my name is Moin, and I will be the moderator for today's meeting. Before giving the floor to Bhavna to start the trail of tax, I will just mention that if you have any query or any question, just do type in the Q&A session. And once the webinar will be over, we'll try to take as much as we can. So Bhavna, over to you.
Thank you so much, Moin, for the lovely introduction. So I'll just request for the presentation slides to be shared, please. Okay, so here, we are on a landmark moment in the history of UAE taxation. So as we know, the UAE Tax Authority has just now issued the corporate tax legislation on 9th of December. And here in this webinar, we are taking you through the key highlights of the corporate tax law, which has been issued. So let's go through a bit about the background as to when the corporate tax law announcement first came into the picture. So sometime in January 22, Ministry of Finance came up with the announcement of the CT regime in UAE. And then in April 22, there was a public consultation document which was released to obtain the feedback from the businesses and stakeholders on the proposed tax regime. And now we already have a legislation, which is the Federal Decree Law number 47 of 22, which is the corporate tax legislation. So we have, divided our presentation into certain key topics, and we will be discussing about those topics. So let's see what are the corporate tax rates and when is the corporate tax going to be implemented in UAE. So currently the corporate tax rates which have been defined in the law are 0% on the taxable income not exceeding AED 375,000. So this limit of AED 375,000 is actually not mentioned in the law, and it has been mentioned that this will be specified in a cabinet decision. However, as part of the FAQs released by the Ministry of Finance, this AED 375,000 limit is there and is also consistent with the the previous announcements and the public consultation document which was released by the Ministry of Finance. So 0% on taxable income not exceeding 375,000 and 9% corporate tax rate on taxable income exceeding 375,000. So what does the taxable income means? Basically, this is the accounting profit or loss of the business. And then there are specific rates on free zone persons. So we will be discussing in detail about the implications on the free zone persons. But overall, the rates which have been defined is 0% on the qualifying income. So qualifying income will again be specified in a cabinet decision, and 9% CT rate will be on other taxable income, which is not a qualifying income. So we still need to wait and see that cabinet decision, how that qualifying income is defined. So currently, we have the law, but in the law, there are certain clauses which are subject to the cabinet decisions. So we still await those cabinet decisions to be issued. And the effective date of corporate tax will be from financial year beginning on or after 1st June 23. So what it means is that, for example, if a company follows a financial year which ends 31st May, then they will have the applicability from 1st June 23. And a company which has a financial year end, let's say 30th June, they will have applicability from 1st July 23. And most of the businesses, as we know in UAE, follow a calendar year, which is the Jan to December. So for those businesses, the corporate tax will get implemented from 1st January 24. So basically, any financial year beginning on or after 1st June 23. So this is the effective date. Can we go to the next slide, please? So here we are going to talk about, taxable persons. What are the taxable persons which are defined in the law? And what is the corporate tax base for those taxable persons? So basically, on which income those taxable persons would be taxed. So the taxable person is divided into two categories: residents and non-residents. Okay, so residents will be taxable on worldwide income. So basically, the taxable income derived from UAE or outside UAE. And so what are those resident persons? So resident persons basically include any juridical person incorporated in UAE. So juridical person meaning a person which has a separate legal identity. So any legal entity which is registered in UAE, incorporated in UAE, will be considered as a resident person. Any natural person or an individual which is engaged in a business or commercial activity in UAE, and there will also be a cabinet decision which will be issued regarding the individual taxability. Or a foreign company which is effectively managed and controlled in the UAE will also be considered a resident person. So this is a very important criteria, which is the place of effective management will need to be looked at to analyze whether that will come into the residence criteria or not. Or there could be any other person which can be specified in a cabinet decision. So basically, overall, if we summarize, any entity which is established, separate legal entity established in UAE, any individual engaged in the business, or any foreign company with place of effective management in UAE would be considered as a resident. And they would be taxable based on the income which is derived from UAE or also from outside UAE. Let's go to the next slide, please. Okay, so what are the key considerations for resident persons? So, like we talked about, foreign company can become a resident if they are effectively managed and controlled in UAE. So basically, this is a very subjective criteria and need to be analyzed in quite a detail to arrive in which cases where a foreign company with can have a place of effective management. So, for example, if the key strategic decisions of the foreign company are made by the directors in UAE, then that could become a place of effective management in UAE and hence could be considered as resident. So juridical person, like I mentioned earlier, is a person which has a separate legal personality from its owners or the founders. So UAE branch of a domestic or foreign company are actually considered as an extension of their head office or the parent and not a separate juridical person, because branches do not have a separate legal personality from their head offices. For businesses like sole proprietorship or civil companies, those would be considered tax transparent, meaning that these will be treated as natural persons for the purpose of corporate tax. Or there can be cases like unincorporated partnerships. Basically, unincorporated partnerships are those where there is a contract where two persons enter into a contract and they are considered as unincorporated partnership, but not actually formed as a corporated entity. So those unincorporated partnership would also be taxed in the hands of the partners for the income generated from the business. Next slide, please. So now let's look at, the conditions for non-residents. So if the person is not a resident, then non-residents will include those taxable persons which has a permanent establishment in UAE. We will discuss, what a permanent establishment means and what kind of structures or fixed places could be included in the definition of permanent establishment. So any non-resident person which derives state-sourced income, again, we will discuss in detail as to what constitutes UAE-sourced income, or if it person has a nexus in UAE. So this nexus will be, specified in a cabinet decision, like in what conditions where a non-resident could be considered having a nexus in UAE. We still need to wait those conditions which will be in that cabinet decision. So corporate tax base of non-resident person, like we saw in resident that they are taxed on worldwide income. However, for non-resident persons, the corporate tax base includes the taxable income which is attributable to the permanent establishment in UAE, or it's a UAE sourced income, or the taxable income that is attributable to the nexus of the non-resident in UAE. So let's discuss some more details about the UAE sourced income and what is the concept of permanent establishment. Next slide, please. Okay, so in which cases an income will be considered as sourced from UAE? So if an income is derived from a UAE resident, if an income is derived from a permanent establishment in UAE, or if the income is derived from certain activities performed or assets located in UAE, or the services which are benefited from in the UAE. So these, could be considered as sourced from UAE. For example, the sale of goods in UAE. For example, if any insurance premium is earned, if that insured asset is located in UAE, or the beneficiary is in UAE, or the insured activities performed in the UAE, then those could be considered as UAE sourced income, or the movable or the immovable properties is located in UAE. And foreign person will be considered to have a permanent establishment in UAE. So basically there are two concepts, which is a fixed place permanent establishment or a dependent agent permanent establishment. Fixed place meaning if a foreign person has a fixed or permanent place through which the business is conducted in UAE, that would constitute a fixed place PE. A dependent agent PE is like, if a person who habitually exercises authority to conclude contracts, to conduct business in the UAE on behalf of the foreign person, then that would constitute a dependent agent permanent establishment of the foreign person in UAE. And any other form of nexus which will be specified in the cabinet decision. So a UAE branch of a foreign business. So for example, if a foreign company has a branch in UAE, that would usually be subject to corporate tax and would be considered as a permanent establishment in UAE unless those activities do not give rise to permanent establishment. For example, those activities are only preparatory or auxiliary in nature. So, these kind of conditions will need to be analyzed in detail to arrive whether a permanent establishment is established in UAE or not. Okay, so let's discuss some more on the concept of permanent establishment. Next slide, please. Okay, so like I talked about, a fixed place permanent establishment. So what can be a fixed place? So basically a place of management where the key decisions, management decisions are taken for related to the business activity, any branch office, factory or workshop in UAE, land, buildings, other real estate property, any installation or structure for exploration of natural resources, mine, oil or gas, or any vessels or structures which are used for the extraction, or a building site or a construction project. Basically, this is like a construction PE where the time limit is more than 6 months. So if a construction project lasts more than 6 months, then that could constitute a permanent establishment in UAE. So what are the exceptions? What is not considered a PE? So basically, if a place is only used for storing display of the merchandise on behalf of the foreign person, that would not constitute, like activities of preparatory or auxiliary nature activities, which I mentioned. So, these could include activities like marketing, the market research activities, which could fall into this category of preparatory in nature. A very important clarification which has been mentioned in the law is that the mere presence of an individual in UAE does not create a PE if that presence is temporary and exceptional in nature. So we have seen, the employees travel to foreign countries for, their work. So this is a very important clarification where, that travel could not be considered a PE, like in the case of employee of a non-resident person is in UAE, it will not be considered a PE if the work which the employee is conducting in UAE is not part of the core income generation of the non-resident or any of its related parties, and there is no income derived from UAE. So there is no UAE sourced income. Then in such cases, the presence of the employee of the foreign person will not constitute a permanent establishment in UAE. Let's go further, please. So we discussed about what a taxable person is, and what is a UAE sourced income, what is the concept of permanent establishment. So in the law there are certain exempt categories of persons as well, which are exempt from corporate tax. So what are those persons? Basically, government entities and government controlled entities here. If the government entity is conducting a business activity which is as per the license issued by licensing authority, then that would not be covered under the exemption. So only the government related activities performed would qualify for exemption. Any businesses engaged in the extraction of natural resources in UAE and the related non-extractive activities which are already subject to emirate level taxation and which will meet certain conditions which are defined in the law, those would also be exempt. Public benefit entities like charitable businesses or certain organizations in the field of science or art or animal protection or other humanitarian entities which will be listed in a cabinet decisions, those would be considered exempt. Certain investment funds, public or private pension or social security funds, again meeting the conditions which are applicable to them in the law, those would be considered exempt. And these investment funds and public or private social funds will need to apply for the exemption to the tax authority. They will not be automatically exempt, but an application for exemption will need to be made to the tax authority. Next slide, please. Okay, so here we are on a very hot topic, which is the implications for free zones in UAE. So as we all know, there are around 40, 50 free zones in UAE, and free zones offer, tax holidays to the entities registered with the free zones. Some offer 15 years, some offer 50 years. So, as initially the public consultation document also highlighted that the UAE will honor those tax incentives subject to meeting those conditions. So, based on the same lines, the law has included certain conditions, but one of the important criteria for a qualifying income on which a free zone will be taxed at 0% still needs to be defined in a cabinet decision. So we still wait that cabinet decision where that qualifying income will be defined. Uh, let's now go into the details about what are those conditions, what are the definitions. So there are certain definitions in the CT law related to free zones. So the first is talks about what is a free zone. So basically any designated and defined geographical area within UAE, which will be mentioned in a cabinet decision. Any legal entity, free zone person. So any legal entity which is incorporated in a free zone. So even a branch of a foreign company which is registered in a free zone will be considered as a free zone person. And a qualifying free zone person. So there is a concept of qualifying free zone person, which is a free zone person which meets the conditions laid out in Article 18 of the CT law. So in the next slide, we will discuss what are those conditions which need to be met by the free zone person. Next slide, please. Okay, so one of the condition is to maintain adequate substance. So there is no particular definition currently about the adequate substance, but we can take some reference from the already existing economic substance regulations in UAE. It must derive a qualifying income as would be specified in a cabinet decision. So this is a very important cabinet decision which we still await, and must not have made an election to be subject to full CT rate of 9%. So free zone person has an option to elect for the CT rate of 9%. If they do not elect, then they would qualify for the free zone person condition. And another important condition is that they must comply with the transfer pricing rules and maintain transfer pricing documentation. So this is a very relevant, important point which has been included in the CT law, is that even the free zones persons have been brought within the ambit of transfer pricing. Can we go to the next slide, please? Okay, so what is the overall impact? So they are definitely within the scope of UAE corporate tax, and they would need to register and also file the tax return on an annual basis. CT rates, which we discussed, are 0% on the qualifying income and 9% on the taxable income, which is not a qualifying income. They can also make an election to be subject to regular CT rate, and free zone persons will not be allowed for tax grouping or transfer of losses between the resident entities. Next slide. So this is basically, the free zone treatment which was given in the public consultation document. So we still need to see whether the qualifying income which will be defined in the cabinet decision would be aligned as per that or not. So just very briefly, what was in the public consultation document was that there will be 0% CT rate for trading within the free zone or with any other free zone. 0% on the income from business located outside UAE. If any passive income generated, there will be 0%. And then 9, if a free zone company has a branch, that mainland branch will be taxed at 9% and 0% on the other income. So we still need to, see whether all these conditions, how these will be defined in the qualifying income definition in the cabinet decision. Let's go further, please. Okay, so like I mentioned, what is a taxable income? Taxable income is basically the accounting income or profits of the business. So how the taxable income is determined? Next slide. So basically, as per their financial statements, all the financial statements must be prepared as per the accounting standards acceptable in UAE. So for example, IFRS is a common acceptable accounting standard in UAE. Financial statements should be prepared on accrual basis unless a cash basis accounting is permitted, which will be specified in the ministerial decision, which entities would qualify for using that cash basis. And to arrive at the taxable income, there would need to be certain adjustments which need to be done for unrealized gains or losses, any non-deductible expenses, any transfer pricing adjustments arising out of transactions with the related parties and connected person, any exempt income, any income arising on intra-group transfers, transfer of tax losses within the group, or any other special reliefs which the business might be claiming. Let's go further. So like I mentioned that there will need to be adjustment made for unrealized gains or losses. So the law gives an option to select. So one option could be that the business can elect for recognizing all gains and losses only on realization basis. So basically, unrealized gains would not be taxable and unrealized losses would not be deductible. Option 2 is that they can elect that they can take on realization basis only the capital nature assets or liabilities, and for revenue nature items these would be included on the current basis. So capital nature items on realization basis, and then revenue items on the current basis. Okay, let's move further, please. So this is just a brief chart which we just discussed about. So starts with the financial profits and then the adjustments. You arrive at the final taxable income. Taxable income up to 375,000 will be taxed at 0%. Above 375,000, the will be at 9%. And then you deduct any foreign tax credits which you might be claiming. And then you arrive at your final corporate tax liability. Next slide, please. Okay, so transfer pricing is a new thing for UAE, and it is one of the important articles which have been introduced in the corporate tax law. There has been reference to transfer pricing in lot of areas, like we discussed. Even free zone persons will need to comply with transfer pricing regulations. So what does transfer pricing means? Basically, transfer pricing ensures that the transactions between related parties and connected person are done on arm's length basis. Basically, on the same basis as a person would do transaction with a third party. So there are definitions in the law about what are related parties and what are connected persons. So related parties are usually, in the case of individuals, the relatives of the individuals up to fourth degree of kinship. And in the case of legal entities, if there is 50% or more of the ownership interest or control in the entities, then those would constitute related parties. Connected persons are like, owners, directors or officers of the company. Those would qualify as connected persons. So transactions with the connected person must be determined on the basis of the market value. Also, the law has included transfer pricing methods, which are, 5 transfer pricing methods, which are aligned with the OECD transfer pricing guidelines: the cup method, the resale price method, cost plus method, TNMM, and the transactional profit split method. So these are quite detailed method, which needs to be looked at in detail, in line with the OECD transfer pricing guidelines. Let's go to the next slide, please. Okay, so there is some transfer pricing documentation which also needs to be maintained. So currently the law mentions about a disclosure form which will need to be filed with the tax return for the details of the transactions with the related parties and the connected person. And in the case of certain businesses, which will be specified in a cabinet decision, the master file and local file details will also need to be maintained, and these will need to be submitted to the authority if they are requested within 30 days. So, this is about the transfer pricing documentation and what are the transfer pricing rules which are defined in the corporate tax law. So now, I'll hand over to Rishi for the next set of the presentation. Over to you, Rishi.
Thank you, Bhavna. Thank you for the wonderful session which you have done just now. I think a lot of important topics are discussed, which definitely has to be researched more. Of course, things like transfer pricing and free zone implications. It looks very simple, but needs a little bit more research when companies are planning for it. All right, so I'll move into some of the other topics which are there, which we thought are quite important, that needs to be discussed. So first among that is the small business relief. So people who have read the public consultation document that was released earlier, this small business relief was not part of the public consultation document. So this is something new which is given in the law. So let's take a look what it means. So right, so basically what it means is that a taxable person, so a taxable person and who is a resident person, means a taxable person means who fits into that formula of being taxability. So we have already seen that even free zones and all the company more or less falls into the bracket unless they meet the thresholds. So any taxable person who is a resident person, resident means resident of UAE, can elect to apply for small business relief for a particular period. So what it means is a taxable person who is a resident person. Resident means a resident of UAE. So we have seen the residency definitions, which Bhavna has already discussed, and who needs to elect for this particular thing to not have his taxable income been subject to corporate tax by applying for it. And this is applicable for a particular tax period. So who is applicable, who is eligible for this? So basically the law says with the revenue for the current tax period and the previous tax periods does not exceed a threshold. So what it means is basically it's not like an automatic thing available to everybody. So first of all, a company needs to elect and apply for it, and there will be a threshold within which that application can be made. So now what is the threshold is still not been given. So the law says that the minister is going to provide details about areas such as this threshold, right? So a UA resident person may elect to claim small business relief. And once this relief is given, or for example, applied for, the tax authority can ask additional questions when they are approving or disapproving this application. So let's look at what are the implications. Sorry for this small glitch there. Okay, so what are the implications of being into the small business relief? So basically, one of the major, obviously, the advantage is that once you are into the small business relief, you will be treated as your taxable income for that taxable period, not to be considered for the corporate tax. So that's the biggest advantage that is there. Secondly, the rules relating to transfer pricing documentation is not required. And transfer pricing documentation, as Bhavna just discussed, is quite an elaborate process. And now the other thing which we need to also understand here is that there are certain things which does not uh, allowed by the law. So basically, there are certain things which you might not be able to enjoy when you are into the small business relief. So things like exempt income, for example, we have understood that I'll talk about exempt income in the coming slides. So basically, exempt income is something which is not considered for your tax calculation. So exempt income, if you fall into the small business relief, the income which is supposed to be exempt will no more be an exempt income. So that means that it will be considered as part of your taxable revenue, right, for the purpose of calculating the threshold. So this is what it means, right? So any kind of gains and losses of intra-group transfers or business restructuring relief will be not given. So what it means is that we'll take this topic also later on. So if certain conditions are met, so any kind of transfers between the group entities, any gains or losses on those group transfer does not need to be subject to corporate tax. So that particular relief, which is available, we'll discuss later in the slides. That will not be available if you are into the small business relief. And thirdly, obviously the deduction. So there are, all the business related deduction or the, for example, expenses incurred for the business purpose, those kind of deduction, which you would have normally got it if you are a taxable person, will not be applicable if you are into the small business relief. Obviously, because if your income is not covered in the taxability, the expenses obviously should not be ideally given also as a deduction. And lastly, the tax loss relief, carry forward of losses. This also topic is there in later slides. So in one line, I would say the losses are allowed to be carried forward into future years. But if you are into a small business relief and there is a loss, that loss you cannot carry forward once you fall into this category, right? So I'll go to the next one. So this is the other one is exempt income. As I was mentioning just a while back, that there are certain incomes which are defined as exempt income. So let's look at it, what it means and what are its implications. So overall, any kind of exempt income, what we'll discuss now, is not considered as part of your taxable income. So what are those kind of income? First is the dividend. Dividend, for example, any kind of dividend which is earned from entities within, like any resident person within UAE, so a mainland company giving to a free zone to a mainland, any kind of dividends are basically considered as exempt income. So that is clarified. And dividend income from a foreign entity also falls into the category of exempt income. However, there is something called a participation exemption conditions, I'll touch on this participation exemption in the next slide, but just keep in mind that dividend from foreign entity can also be exempt income provided it fits the definition of participation exemption. So what is that exemption? We'll talk in the next slide. Same thing, capital gains and any other income from capital gains and other income. Any kind of those income can also be exempt income if the participation exemption definition is met. So we'll see what a participation exemption is. Fourthly, the income of a foreign PE, so permanent establishment of a foreign entity, can also be into exempt income. However, we have also one example on this particular point in the later slides, but they have to like consciously make a decision. So if elected, you can see the word if elected, then the income of foreign permanent establishment, it's mainly for the branches, will not be covered in the taxable income if an election is made for that. And lastly, the income of non-resident from operating aircraft or ships in international transportation can also make use of this particular provision. So I think income, sorry, it came a little later. So income and related expenditure not to be considered in determining taxable income, which I mentioned in the beginning. So any kind of income and the related expenditure, like dividend or related expenditure related to dividend, will not be considered in determining taxable income. So that is what it means, exempt income. So yes, so what is participation exemption? So this is a very peculiar point. I would request to just pay a little bit attention to this point. So it says that if a participation exemption basically applies to two things. One is foreign company dividends. Secondly is capital gains, which could be domestic or foreign. So when we say capital gains means profit or loss on sale of sale of shares. Basically, that is the capital gain we are looking at right now. Right. So in order for these kind of income, which is foreign dividend and capital gains of domestic or foreign, can be into the exempt income category, provided these conditions are satisfied for participation exemption. So we will have one example on this particular point. I know it is a little bit complicated, but we'll try to simplify in the example in the next slide. But let's still understand what it means. So in order to qualify for a participation exemption, the UAE shareholder must hold 5% or more of the ownership of the subsidiary. So for example, a UAE entity, if it is getting dividend from a foreign company, it must own 5% or more of the shares of that foreign entity. So that's condition number one. Second condition is that if you are getting any kind of dividend from foreign company, foreign subsidiary, or any kind of gains on sale of shares and all you're getting from a foreign subsidiary, then that particular country should have a corporate tax which is equal to or more than 9%. So if there is a country where you have a subsidiary and you're earning a dividend, or for example, getting any capital gain from that particular country, where the tax rate is equal to, where the tax rate is less than 9%, then still you will not qualify into this exemption category. So that's important. So the country where your subsidiary is located should also have a tax rate which is more than 10%, more than 9%, sorry. And the third condition says that once you have those shares purchase, or once you take advantage of this particular condition, the minimum holding period should be 12 months. So you need to hold those investment at least for 12 months in order to make use of it. So what happens is, for example, if in future there is a sale purchase happens, then this condition, then at that particular point of time, you have to reverse this exemption which you have taken earlier and account for it at that particular day. So there are different rules for that. I'll not go into it right now. And the fourth, it says there's one more condition which talks about if there is ownership of 50% by direct or indirect in the investee asset. So this is a little long discussion. We can go through in the law later on. So these are more or less the four conditions which are mentioned. And one more point which is mentioned in the law is that that there's a possibility that any kind of strategic investments, cabinet decision or the minister can actually declare any particular kind of investments in participation exemption category, even if they are not meeting those conditions. So for example, if there is a country where the tax rate is less than 9%, I mean, going by the definition, you cannot be the exempt category here, but the minister or the cabinet decision may still allow it. So that is like ad hoc that may happen as per the decision of the cabinet. Right, so let's look at this example to simplify and understand a little bit more easily. So basically what we are looking at is that there's a UAE holding company, which is a mainland entity. So it's owning four entities. So it's owning, say, UAE company, where the ownership is 3%. Then secondly, it is owning a US company where the ownership is 4%, and it's owning a Bahrain entity where the ownership is 96%, and it's owning a China entity where the ownership is 80%. Now we know the corporate tax rate in this particular locations like UAE, we have going to be 9%. US is average 21%. Bahrain, there is no corporate tax. China is averaging around 25%. So this is the given situation. So now we have to see, like if the UAE holding company receives a dividend from a UAE company, first of all, dividend will be exempt. We have already discussed that any dividend within UAE will be exempt. So that's very categorically mentioned. So a dividend between entities within UAE will be exempt. So even you can see here that the ownership is 3%, which is less than the participation exemption. So what is the participation exemption limit? That is 5%. So even if the participation exemption is less than 5%, since it's a resident person, the dividend income will be exempt. Okay. So that was the first condition which was mentioned. If we go back, here you can see the first point, dividend from UAE entity applied to dividend from person exempt or whatever, 0%. So dividend from any UAE entity will be exempt. So that's clear. Then, but the rules for capital gains and foreign entities falls into the participation exempt category. So looking at the first example again, so if any kind of dividend is received, even if the participation what you call interest is less than 5%, still that dividend income will be exempt. However, if it is a capital gain, so if there's a profit on sale of shares or things like that, then you have, even for a domestic company, you have to still satisfy the condition of participation exemption. So now in the first example, you can see the ownership is 3% and not 5% or more. So the capital gain will become taxable. However, the dividend income will be exempt because it's a resident entity, but the capital gain will become taxable because you have to satisfy that 5% condition for the participating interest. Right. So going to the next one. So in the US entity, which has an average rate of 21%, the ownership is 4%. So ownership now in this case, both needs to be satisfied. So in dividend income and capital gain, both has to meet the participation interest condition. So which is not met here, since the participating interest is less than 5%. So both becomes taxable. So going to Bahrain now. This is another interesting example. So Bahrain, the corporate tax rate is nil. So what happens to the dividend income and corporate gains? Both become taxable. Reason being, first of all, this dividend is a foreign dividend. So foreign dividend, you have to ensure participation exemption condition is met. So that participation exemption condition is met. So not a problem. Okay. Now the other condition, what it says is that other country should have a corporate tax rate of 9% or more. So now in Bahrain, the corporate tax is nil. So the condition of participation interest is not met. That's why both dividend and corporate and capital gains become taxable in this case. In the last one, China, the average is 25% and the ownership is 80%. So both conditions are met. So we have more than 5% ownership and we have corporate tax rate more than 9%. So both dividend income and capital gains becomes exempt. I hope this simplified this a little bit. All right, so now let's look at the foreign branch exemption example we discussed. So what was the point? The point said that a foreign branch can elect to fall into the exempt category, but there has to be a election first of all, and secondly, the company the country for which the part of which that branch is should have a corporate tax which is rate is more than 9%. So in this example, so a branch of a US company is in UAE where the corporate tax is 25%. Now, since the rate of tax in US is more than 9%, they can elect for the exemption. However, when we compare to the other example, which is branch in Bahrain, where the corporate tax rate is nil, they cannot elect also because they don't have a tax rate of 9% or 9% or more. So this is very briefly, the election criteria for foreign branches. So now we discussed a little bit earlier on the group transfers and business restructuring relief. So group transfers, it means basically if there are two entities, for example, in UAE, and there is ownership in those entities, and they have a relationship by way of ownership, then what are the tax treatment for those things? So we'll discuss that. And the secondly, business restructuring relief is like, for example, if there is a sale purchase of shares in the entities or any kind of restructuring, what are the reliefs available? Right. So any kind of transfer of asset or liabilities between entities. So if there is any gain or loss, for example, that may accrue because of transfer of asset liabilities between UAE resident or non-resident that have a P in UAE. So UAE resident, we understand UAE resident means any taxable person in UAE, which could be in mainland, free zone, whatever. Any sorry, free zone, there is exception. So free zone, it's very categorically mentioned. None are qualifying, free zone will be covered. So UAE resident means mostly will be the mainland entities. And secondly, a non-resident that has a permanent establishment in UAE. So Bhavna has discussed the P concept earlier. So if non-resident that has a P in UAE and is a resident or a UAE resident, they can apply for having those transfer within qualifying groups to avoid paying taxes or account for what you call the transfer pricing and those kind of areas. So first of the condition is that the common ownership should be at least 75%. That is one condition. So if there is company A and company B, the ownership percentage should be at least 70%. That is the relationship they should hold. Secondly, no member is an exempt person, that is required. And none of the entity should be a free zone person. So I mentioned just a while back that if there is an entity who is a UAE resident, but it's a free zone person, then this will not apply, right? And the other condition is that the member should follow the same accounting standards and they should use the same financial year. So a company which is following a calendar year, Jan to December, the other entity should also have the similar pattern. That is important. And the other condition which says is that in order for this exemption to hold good, that there should not be any transfer for within 2 years. So within 2 years, for the next 2 years, once you have made use of any kind of transfers within the qualifying group, then that ownership structure or that pattern should stay for at least 2 years. So if that changes, like for example, within 2 years, if there is a change, then on that particular date, it will be considered that the transfer has taken place, and then the market price of that particular date will be considered. Normally, any transfer within qualifying group is required to be done at net book value. So there should not be any gain or loss in the transaction. So there is no requirement of your transfer pricing in this case. However, the moment you are disqualified from being a qualifying group, then and if that has happened within 2 years, then on that particular date when you are disqualified, that is the date where you have to apply the market price on that particular, and that date will be considered as the date of transfer. So this is something. If you have used this particular article, then ensure that you maintain the requirements in the next 2 years. So I've also taken a an example on this particular thing as well. So, for example, you can see there's a UAE LLC transfer some goods to XYZ, the first one on the left. So UAE LLC transferred some assets to XYZ UAE LLC at a net book value. So, and the ownership pattern is 80%. So they own more than 75%, right? Very clear. So no gain or loss for CT purpose. So any kind of transfer or any kind of profit or loss, it may happen. It's not taxable and there is no need of a transfer pricing. So it's fine, simple, clear. The second one, UAE LLC transfer asset to XYZ LLC at net book value, but the ownership in this case is 20%. So now in this case, you are not meeting the conditions of a qualifying group. So ownership is less than 75%, then the gain or loss become taxable, right? And again, the provision of transfer pricing will come into picture. That's another set of discussion. The third one is that UAE LLC transfer assets to XYZ LLC at net book value. Again, this ownership is less than 75%. So any kind of gains or losses will come into picture and the transfer pricing rule applies. And the last one is XYZ transfer assets to XYZ FZD. So, and the ownership is more than 75%. So now FZD free zone is categorically been taken out from this particular article. So if there is a free zone to which this transfer has happened, and that free zone, even the ownership is more than 75%, still you cannot apply the ruling, the benefits given by this particular clause. So still has to follow the transfer pricing rules, and then the gains or losses become taxable. So business restructuring follow the same pattern which is mentioned in the group structuring. Only thing is that one of the most, so I'll just try to simplify in one line, is that any kind of transfer of business, like as an entire business or an independent part of a business to another taxable person. So for example, if you transfer the business or a part of the business to somebody else, first of all, that other person should be a taxable person to whom the transfer has happened, or will become a taxable person upon transfer. So if a person stays like an exempt or something of that category, these provisions will not apply. So it has to be the other person should be a taxable person or will become a taxable person on transfer. That's condition number one. Secondly, the payment or the settlement should be through ownership, through shares or other ownership interest in that particular transferee. So that's two conditions very important. Secondly, firstly is that when you transfer your entire business or independent part of it to other party, that party should be a taxable person or will become a taxable person, condition number one. Secondly, the payment or the settlement for that should be in form of shares of that transferee. So that is very, very clear. So once these conditions are met, you can have the similar benefits which is there for group which we discussed, no gain or losses become taxable. You can transfer at net book value and those kind of things will apply. Of course, condition of non-FZD person, same financial year, same accounting standards apply. And the transfer can be done at net book. It has to be done at net book value actually. And the same condition of 2 years condition which we discuss in the group also is there in this as well.
Sorry, Rishi, can you please inform the participants if the presentation will need to be extended for a certain time, because we are already 12:32.
All right, sorry, I think it's a little complex, so it's gone a little bit more than the time projected because the concepts are a little technical, so I'll try to make it faster. So please allow me another 10 minutes to wrap it up. If you have to go, I can understand. We'll share the recording with you and the slides. But if you can stay, it'll be so nice of you. I'm sorry, I just did not see my watch. Right. So I'll just very quickly go into without taking more time. So let's look at the deductions. So all kind of business related.
I think participants are showing interest that please carry on explaining.
Okay, thank you very much. Because it takes it's like diving into the sea. You don't know how deep you have to go, and when you have to surface. If you like the like the environment inside the sea. So sorry for that, for taking it, but let's get into it. If you have to go, we'll share the slides with you and the presentation. All right, so deductible expenditure. So any kind of business related expenditure other than capital expenditure is allowable. So you can, so for any taxable income, you have the expenditure, you can deduct that expenditure. That's fine, simple, no problem. But that expenditure should be incurred within the tax period. So that is very important. So you cannot push your, like for example, incurred means incurred. Like if you understand the concept of accrual, it's incurred concept. So that's very important, is that payment is not what you have to look at. You have to look at incurred. It's a date of invoice, the date of service, and all that has to be looked at when you're dividing your tax periods. So that's important. And another thing which it mentioned is that in case if there is an expense which you incurred for more than one purpose, like some part is for the exempt related and some part is for the taxable related, so you can do a proportionate deduction. There has to be some formula which the cabinet decision will define. So exempt income, for example, dividend related revenue efforts are put, or then still you're doing business. So if there's a mix, you can proportionate deduction can be used. And there are certain disallowable expenses. So what are the disallowable expenses? Very clearly, very simply, non-business expenses, not any kind of personal nature. When on the face of itself, it looks like a personal, even if in the name of the company, but the nature, you have to see that it is for the business purpose, then it is allowable. If it is not, it cannot be allowed. So you be very careful, because once your file is filed, only things will come up when the audit happens. So be careful there. Any expense on the exempt income obviously is not allowed. So interest expense. So interest expense, there is a very long discussion on in the law, but I think they have made it easy and quite comfortable for entities to make use of it. So let's look at it. So interest expenditure is deducted in the taxable period in which it is incurred. So obviously, if you have incurred tax, any interest in say, for example, if you are becoming taxable in 24 and you have incurred any interest in 24, then you can claim the interest expense in that particular year. So if any, before the taxability or before your tax period, any interest which is accrued before which you pay later, that will not qualify. There has to be in that incurred in that particular years to use it, firstly. And then there is a limitation rule. So limitation rule in very simple line is that you can deduct the entire interest which you are paying for the business related thing, but there is a limit been prescribed, which is that in the first year, or say in a particular year, you can claim up to 30% of EBITDA. EBITDA is earning before interest, tax, depreciation, and amortization. So up to 30% of EBITDA, you can claim the interest in that particular year. Rest of the interest you can carry forward in the future years, but the carry forward in this is limited to 10 tax period and not more. Like in the case of carry forward of losses, if you ask me, the rule is little different. We'll touch upon it later. But in the case of interest, particularly the carry forward is only up to 10 tax periods, right? And this provision does not apply to bank, insurance provider, natural person undertaking a business activity, and any other specified person. In case of a related party loan, there are specific conditions we mentioned. So very clearly and obviously, I think it is there, is that if there is a loan taken on which an interest is paid, and the purpose of that loan is related to the dividend or any distribution of profit, that particular interest cannot be claimed here. Very clearly, because dividend income, we understand, is an exempt income. So any income which is exempt, then the expenses related to that is also exempt. So any kind of dividend income or profit distribution in related interest is not allowable. So similar provisions are mentioned here. Now the next thing is entertainment expenditure. So entertainment expenditure include like accommodation, transportation, any kind of admission fees and things like that. So you can claim entertainment expenditure, but up to the limit of 50. Clear. There are certain non-deductible expenses that are not allowed. One is that donations, grants, or gifts of that nature. However, if these donation grants are given to a qualifying public benefit entity, so what is that is going to be defined by the cabinet resolution. Most likely, it has the authorized government entities who are taking the donation. That expense can still be allowed, but not like generally giving to anybody. Right? Any kind of penalties or fines is not allowable as a deduction unless there's a compensation for damages, which is a different topic. Any bribes or profit distribution, definitely dividend or profit distribution cannot be allowed because dividend income is exempt, so expenses is also exempt. That's not allowed. Any drawings by the shareholder is not allowed. That's an important point because in UAE, I've seen it's a very common practice that there are drawings from shareholder, which is at the end of the year in the audit has been put as management compensation and put charged as an expense. So please, if you have those kind of expenses in your P&L, watch out for this provision and do a little bit of thinking on how to structure, because I understand shareholder is also working for the company. So his time is getting used, so he needs to be paid for the time spent. But you need to really understand this particular point for that particular expense on your P&L. So any corporate tax paid, you cannot claim as a deduction. Any recoverable input value added tax, same provision. And any tax imposed outside the state is also not basically claimable. And there can be any other item which cabinet can decide. So carry forward setup of losses. This is also very easy and simple. They have clarified. So carry forward losses is allowed for indefinite period. There is no limited. There is no limit. The only condition I'll first take up the set off. This says that you can set off your losses in the next years up to 75%. 75% of the losses you can set it off next year, and any balance left you can carry forward to n number of years. So there is no limit prescribed there. Simple. And secondly, the carry forward, there is one condition here is that, so in case there is a shareholding change in between, so any business that goes through times where new people join into the business or people leave from the business, so change in shareholding is a very common practice. So if there is a change in the shareholding pattern, this condition needs to be looked at. So for example, you can still carry forward the losses to a number of years you want to do, but you have to ensure that first condition is that there should be same shareholders for at least 50% of the share capital. So what this condition mean here is, like for example, if you are doing a general trading business, right? And in between, there's just shareholding change pattern, and the new partners decide that, okay, let's change the activities from general trading to say oil and gas trading or something particular which is different from that activity that is there. So if that happens, to carry forward those losses of previous year, the same shareholder should be at least 50%, right? Very clear. But if there is a shareholding change is more than 50%, the second condition applies. So if the shareholding change is more than 50%, then you have to ensure that the same or similar business is carried. So very, very simple terms that if you are holding the same business, carrying the same business, the shareholding change, even if it is more than 50%, does not matter. Same business, you can carry forward the losses. But if there is a change in the shareholding pattern and there is a shareholding change in the shareholding change pattern and the shareholding change is more than 50%, the similar business must be carried forward. So you need to be careful when ownership change in the taxable year. So there are certain losses which cannot be utilized. One is that anything before the effective date of CT and person losses incurred before a person become a taxpayer, obviously, and losses incurred from activity which are exempt. So obviously exempt items, any losses cannot be carried forward. So transfer between resident person, I think we have already covered this point that common ownership should be at least 50%, and and the financial. And so this is basically a transfer between the group. We have already covered this point that the minimum ownership should be 75%. So this is again the same point. So I think I'll just skip this slide because we have discussed this. So there is a possibility to make tax groups within entities. So there is possibility then you can group two entities together. So there are certain conditions that the ownership should be at least 95%. That's condition number one. And the secondly, the both parent and subsidiary should have the same financial years and same accounting standards. And free zones and exempt companies are excluded from this particular condition, so they are not part of this particular thing. Another thing is that once you form a tax group, we understand that the limit for registration is 375,000 dirhams, right? So that once you have a tax group limit and you have more than one entity in the group, the 375 is applied at the group level, not at the entity level then. So once you are into the group, it is considered as one entity and 375,000 looked at one. But so this is something to keep in mind. We have a example, but I'll not discuss in very detail given that I'm running a little late. So this is one example. You can see but just I'll simply discuss this particular point. So LMO, LLC, ABC, LLC. So the exemption threshold 375 applies. But once you have a tax group and you add this LMO and ABC together, then still you have the threshold of 375 for the group. So you cannot basically utilize for per entity once you are a group. Mostly this kind of grouping will be useful once you have one of the entity making losses, then it makes sense. And also if you want to avoid the condition of transfer pricing, that can also help if you have a tax group. So this is something to think about. So very briefly on the compliance requirement. So there is no registration threshold for UACT. Also all businesses has to register and deregister. Bhavna has already taken it up. And all entities have to file their annual return within 9 months from the end of the relevant tax periods. Free zone entity, please note, free zone entities also required to register and file returns. The filing of returns will be on self-assessment basis, and FTA audits can be expected. Audited financials in case of certain taxable persons will be required. That will be mentioned in the cabinet decision, but what we understand is this audited financial is going to be a regular exercise. So if you have not prepared for it, so start preparing, and better to be in that line in the coming years. And documentation has to be maintained for 7 years. So transitional provisions. So in very briefly, transitional provisions means like when you shift from non-taxable to a taxable category, that is called a transitional provision. So for example, if an entity becomes taxable on 1st January 2024, that is the day that transitional provision will apply to that particular entity. So for example, if I own an entity which has a calendar year end January to December, so 1st January 2024 is going to be the first day of tax period for me. So my balance sheet on 31st December 2023 is the balance sheet that is a transitional balance sheet. So what it says here is that the balance sheet on that particular date should be at arm's length. Very, very important point. Arm's length means the transfer pricing regulations to be looked at that particular balance sheet on that date. So this is very, very important. Please spend some time on it, because don't wait for the tax to start. This has to be seen beforehand and to be ready before you start your tax year. Okay. And there are provision of general anti-abuse rules. So anti-abuse rule mainly means that you cannot do any kind of tax planning in order to avoid taxes. That is called anti-abuse rules. So once the tax law is issued, that general anti-abuse rule provisions apply. So the moment tax law is issued, any kind of tax planning in order to avoid taxes is not allowed. This is what it means. So I've already discussed this in the previous one. So I'm at the second last one. So how do you do it? First is that impact assessment, do your entire reading of the CET law, see how it is applying to your company. Look at the FAQs issued by MOF, very comprehensive, beautifully done, I would say. I can see the amount of efforts put. Please read it. And if you are not able to understand very clearly, have somebody who can assist, who is technically equipped to handle your case. Have some tax consultants spend some time, because this structuring is going to go forever from here, right? So it's important that impact assessment is done properly, and then in detailed assessment and design, and then implement is of course on the date of the corporate tax is implemented, and operate post implementation, basically any kind of return filings, and taking care of the TP rules and things like this. These are the important things which needs to be looked at. Your restructuring opportunity, if you have to do it, think about now. Of course, there should not be anti-abuse, which we have discussed. Review your TP policy. Transfer pricing was never here. This is the first time here. So this is one of the most complicated one and costly exercise for companies. So don't wait for late. Do it now, because if the time is gone, the implications are huge for this, because this is a little lengthy exercise. Ensure your existing financial records and control in place. Get your financial in audit shape. That's very important. IT infrastructure should be updated. Stakeholders, make a session with the stakeholder, shareholder. Let them be aware of the high level impact of these conditions, especially those, like drawings of the shareholder, those kind of areas. You have to make them aware, think about it. And also review the tax group formation thing. That's it. That comes to Q&A. I think we are running out of time. Thank you very much. So I'll go back to Moin. So Moin, can we just close the meeting? I think we'll send this slide and answer any questions one-to-one.
All right. I do have a list of questions. Well, I think we are also running out of time, so we'll take them over the emails, and we'll definitely send them slides. Thank you so much, Rishi and Bhavna, for your wonderful presentation. And yeah, look forward to you, and we'll be sending the slides to the participants.
Yes, slides and also the recording. We will share it with everybody, and Q&A. Please write to us directly, and